This is InvestTalk. Independent thinking, shared success.
Hi, it's Alex here from the UK. I was hoping to get your view on a company, Mastech MTZ, and I was just wondering, is this a time to buy or is this something worth selling and moving on from? I look forward to your answer.
Mastech Inc., ticker MTZ, is an infrastructure construction firm. It's a mouthful, tongue twister. And they specialize in energy, utilities, and telecommunications infrastructure projects. They've had a lot of growth over the past couple years, right? Their revenue growth is around 11.4% on an annualized basis, especially coming out of the pandemic, where they have really nearly doubled in 4 years their revenue. And because of that, this company's been doing pretty well on a relative performance perspective relative to the S&P 500 ever since then, especially last year and this year. It's up 51.88% over the past 52 weeks. It is up 20.16% year to date. It's up 35.77% over the past 3 months. Now, this company recently, it looks like, had a acquisition that it announced a $1.1 billion cash and stock deal to acquire IEA. And so that is going to expand its footprint on the utility side and the communication side, which makes up a pretty big chunk of this business. That's about half of the business there. Now, when was this thing announced? Let's take a look at when this was announced. Bear with me here. And the reason why we want to know when this is announced is because we care about market reactions. And because the difficulty oftentimes with these types of mergers is, it looks like it was actually fully completed in 2022. So the difficulty is within the integration aspect of bringing in this company, finding out the synergies, finding out the ways that you can improve the business. And so from there, over the past couple of years, it seems as though they've done a good job of doing that. Obviously, because again, their communications and power delivery segment has grown to about 50% of their business. And that's where most of the growth has been over the past year or so. Now, understandably, right, this type of business is going to be very cyclical. Now, in this country, where I imagine most of its business is, let's take a look, 99% of its business is, well, we're moving into an era of expanding fiscal deficits on the revenue side and not necessarily the spending side. And so as utility projects generally need to have some sort of backing from the public sector, not just the private sector, as well as communications and clean energy and infrastructure, well, is it the case that maybe growth is going to start to slow? From their perspective, they don't really think so. They still see nearly 10% growth towards the end of this year. And in that time, their margins, pretty lean, right? They lost money in 2023, 1.3% in 2024, 3.5% is where it's projected to be in 2025. Debt perspective, not too much debt, $12 billion company. Give and take here, right? I think it depends what part of the cycle you think they're in. They can have some near-term challenges in terms of execution, in terms of financing as these projects become more expensive. And so because of that, while it's trading at a 24.9 times forward-looking earnings multiple, 11.7 times cash flow with the run-up that it's had, and it's been a pretty significant one over the past 18 months, I would be on a wait-and-see approach here. It's reaching a new high over the past 52 weeks. Maybe even a new all-time high. Yeah, a new all-time high of 163.59. I would wait and see here, wait for a little bit of a pullback, wait till it moves back towards that average price to earnings of about 19.6, because revenue is slowing down, margins are very tight, and where we are in the cycle is not really advantageous for debt-intensive construction companies. That is Mastech Inc., ticker MTZ. Thanks for the call. Let's go to Sammy from San Francisco, who has a question about Micron and is listening on AM 1220.
Hey, Luke, thanks for taking my call. I'd like to know if I should continue to hold Micron. I bought it a few months ago, around 105 or something, and it went down all the way to $90, or maybe even lower. And now it has come back with a vengeance. So wanted to check with you to see if I should dump it or hold on for a while.
Yeah, so Micron, which is a memory and storage solutions company, and a lot of their revenue has been driven by the AI craze, is a company we actually hold for investors in one of our strategies. Now, buying it at 105 is great when you're at 119, and in reality actually dipped down to $68 at one point in the past couple months. So it had a huge drawdown on the back of, well, post-Liberation Day tariff issues. And then it has come back with a vengeance, and that's because subsequent earnings from a lot of these companies that are within the AI data space have shown that growth really hasn't slowed at all from a CapEx perspective from a lot of these companies, right? You're seeing revenues projected to grow from 25 billion last year, and by the way, the year before is at 15 billion, to around 35 billion this year. Now, if you're looking at my screen, if you're watching this on YouTube, you can see how volatile this name is in terms of revenue, right? From 30 billion to 15 billion to 25 billion, all over the place. They oftentimes are, or one time in the past 6 years, they were negative 37.5% net margin, or they can be in the 20s. And so this is the type of name that, because semiconductors are cyclical, because the sector itself is cyclical, you have to be able to stomach some of that volatility. Now, at one point it was trading at like 140-ish. We trimmed some for our clients there. We bought some again below 100. We have been, full disclosure, starting to trim as well because we have seen this really big run up. Now, with tensions in the Middle East, my main concern for this name isn't, what the projected revenue is, because their high bandwidth memory demand, incredibly strong. They said they're sold out for 2025, have record revenue forecasts. It's that these things can kind of turn on a dime, right? We're seeing in the Eastern Hemisphere tensions rise. Maybe while we're looking elsewhere, some things can happen in the South Pacific, and this thing can turn on a dime. And so in situations like as this, when you have seen this company rise about 42% year to date, I still think it's a good hold because of the revenue and growth we've been seeing out of this industry. But certainly if you're at a gain, if you're overweight, I would start to trim. Given, again, how volatile this has even been in the past 6 months, you're going to really see what can happen in a name like Micron, which we think is a great name. But these things are cyclical, so understand the risk profile. We're going to continue to hold, though we are starting to take some profits here. That's Micron Technology, ticker MU. Alrighty, let's keep things moving and answer a caller question now. Actually, let's answer a question from YouTube. I got a little bit ahead of myself here. This one is on ticker NEE. From our friend Selena Marie, and it says, what are your thoughts on NEE? I'm looking to add a utility company to my portfolio. Alrighty, Next Era Energy, that is ticker NEE. And Next Era Energy is a renewable energy utility company. So they do power generation, transmission, and distribution, and sell electric energy in Florida. 69% of the revenue coming from that Florida power and light segment. Now it's up about 2.92% year to date, so it is positive, slightly outperforming the S&P 500, though underperforming its industry as a whole on the year. And over the past 3 months, well, it's pretty flat. Overall, 3 months over the past year, very, very flat. It's underperformed its industry each of the past 4 years. And it looks like really the revenue's kind of all over the place. Took a dip after 2022. And they're in that time, though, right, their margins did continue to expand. About 32% net margin in 2023, projected to be about 27% this year. For utility, it's pretty expensive, trading at 20 times forward-looking earnings. And its dividend is okay. About 3% dividend yield is where it stands right now. Now, from the strength side, right, they do have relatively steady revenue. They have relatively steady growth. They have solid expansion of their renewable segments as well. But top line growth continues to fall below consensus expectations. And you do have a lot of regulatory uncertainty when you're talking about a climate policy debate. And so, I think when you want to tilt towards utilities, you want to tilt probably more towards natural gas, traditional electrical utilities, areas where you're seeing a lot of demand from what's really been driving CapEx across the board. Look for companies that have pretty solid debt levels. This one's got about $72 billion in debt on a $154 billion market cap company. Honestly, growth all over the place. Margins, okay, pretty solid, little expensive. I would look elsewhere. That is NextEra Energy, ticker NEE.
Hello, Justin and Luke. Matt from Minneapolis here. I've had NUE for a long time, made some money in it, but it's been in just a stalemate, it seems like, for about a year or so. Well, I think now there might be a tariff or something on steel, and I don't know if it's going to go anyplace or not in the next 4 years, possibly at least. I'm considering dumping it, or most of it at least. I know this one you're going to tell me is probably overpriced, but I'm thinking of it because I know it always has contracts, and the way things are, unfortunately, it seems like it's producing and selling its products. And that one, of course, is LMT, Lockheed Martin. Would this be a good move? Thank you. Look forward to listening to your answer. Have a great day.
So Nucor, ticker NUE, let's pull it up here, is a steel producer. They're one of the leading steel producers in the United States. Over the past 52 weeks, they're down 21%. They produce steel for the automotive sector, for construction, and for energy markets. And because of that, they're incredibly cyclical. And so slower demand in those things, higher part costs from external areas driven by tariffs have really driven this thing down about 8% over the past 3 months. And like you said, right, there has not been a lot of positive movement here. And that's because revenue growth has really been negative since 2022, down from $41 billion in revenue, finally projected to grow again, but it's been a tough time. And so from the first part of the question, should you move out of Nucor given the macroeconomic headwinds? I would say yes. But the question is Lockheed Martin where you want to put your money? Now, Lockheed Martin is a global security and aerospace defense company. And obviously people are top of mind with some of these aerospace and defense companies because tensions are rising, right? Not just in Eastern Europe, as they have been for quite some time, but now the Middle East. And we do know that the Pentagon, again, is the budget is projected to, if it stands, be around $1 trillion for the first time. Now, on a positive side for Lockheed Martin, we are seeing some expanding margins projected this year, right, from 7.5% to 8.6%, though that is lower than the roughly 10% they've seen over the past 5 years. Revenue growth, yeah, they are growing pretty slow, though, at 3.5%. I don't think they're that expensive at 17% net margin, and they are still a critical company within the military-industrial complex that is the United States. But one of the things that's driving them downward is, well, maybe easing off of tensions, yes. Maybe that's why they're down 4% today. But overall, right, they have had some pretty bad news regarding the F-35 orders that were reduced from the U.S. government, rising costs of the orders from Canada, rare earth metal issues out of China, albeit there is some delay in terms of when restrictions would be implemented. Remember, there was a deal with China to delay that another 6 months. And so, if you're looking for a stable name that's going to give you a decent dividend that's pretty consistent, I mean, Lockheed Martin tends to be that way, right? They only have a 57 payout ratio and about a 2.7% dividend. They do buy back shares, so total return basis looks pretty solid as well. But they have their issues. They certainly have their issues. I don't know if this is necessarily the right name for you right now. I think that they do have some headwinds from the government contract side and a lot of competition as well. I do like your thinking. Maybe look elsewhere within the aerospace and defense industry. That is Nucor and Lockheed Martin. Thanks for the call. Alrighty, let's play 2 in a row.
I was wanting to ask you about Sunoco, ticker symbol SUN. I was wondering what might be a good entry point and what you think about the company in general. So at any rate, thank you for everything that you do, and I will be listening on the podcast. Thank you so much. Bye.
Sunoco, ticker SUN, is a wholesale distributor of fuel, and so most of their revenue comes from fuel distribution. They have a little bit of revenue coming from their pipeline and terminal segments. But overall, they've had a rough 3 months, down about 8.5% over the past 3 months. up about 1.85% over the past year and up about 3% over the past year to date. Sorry, blanked on that. Sometimes my brain shuts down. Now they are a master limited partnership, so understand what it means to own something such as that. And they have been going through some pretty major acquisitions, right? They acquired Canadian Parkland for $9.1 billion. That's set to close in the second half of this year. And so again, anytime you have companies that go through this purchase and synergizing, you can have some issues there. They do have a really high dividend, about 7.9% dividend yield is what they have right now, which is pretty much in line with where it's been. As high as 11.5% in 2020. And their payout ratio is only 57%, so they do have a lot of room to run there. Cash flow, though, has been pretty flat. Margins have been headed downward as well, right? They've been headed upward. Apologies there. They have been headed upward just slightly from 1.3% in 2023 to 3.2% in 2024. And revenue growth, it's fine. Most of it coming out of the pandemic, understandably. I don't know. For me, if I was to invest in a distributor, I would probably right now, given some of the cost pressures and demand pressures that we're seeing, be towards one of the larger companies, right? This is only an $8 billion, $7.2 billion company with $7.99 billion in debt, actually $8.2 billion in debt as of the most recent quarter. Again, you're buying something near the lows here, although there has been a little bit of boost to energy recently. But given the environment, I would rather be with a company that is larger, has more diverse offering, has the ability to control some of those cost pressures moving forward. That is Sunoco LP, ticker SUN. Looks like we got another live call. Larry from San Francisco has a question about rolling over an IRA.
Hello, thanks for taking the call. Love what you guys are doing for us out here.
Yeah, of course, Larry.
I separated from an employer, and it was a defined benefit plan, a pension. I rolled over it was about $100,000 to IRA Fidelity.
Okay.
And I hold about 15 positions already, and I'm just wondering how to divvy that up. Of course, I'm heavy in tech. About half my positions are across that the Mega 7 or whatever it is. And I'm asking, how do I dollar cost average month over month, or do I just put it all in at once? I'm 45. Just looking. I'm aggressive growth is my style right now, my investment style. So I'm just looking for a second opinion on how to go about, kind of dollar cost averaging, or just kind of throw it in lump sum.
Yeah, well, the research is interesting on this, but again, it's kind of difficult, right? Because timing is so hard, right? So time in the market beats timing the market. And when you look at dollar cost averaging versus lump sum investing, the research that I saw actually shows that lump sum investing have higher expected returns. Now that keeps in mind that typically lump sum investing is done on down days, right? And so from a risk perspective, just given where we are in the market right now, we're pretty elevated. You have rising tensions in the Middle East. You have pretty much a Goldilocks scenario on earnings. If it were me, I would continue to dollar cost average in. Now, you mentioned that you have a lot of exposure to tech, so be cognizant of the risks you're taking on. Obviously, you're a growth investor, but you do have to be aware of some of those risks and how those companies would react should things move south pretty quickly. And so I would advise you to continue to be as diversified as you possibly can when you're reinvesting your money. Keep in mind, right, it's a good time to be patient, right? You can get pretty solid yields by keeping your excess cash in something like SGov and getting interest. And so you have the ability now to dollar cost average, understand the risks of where we are and what is on the horizon. I wish you the best of luck. Thanks for the call. All right, let's talk a little bit about some of those rising tensions. And obviously we all have been paying attention, seeing what's going on in the Middle East between Israel and Iran. And there's a lot of speculation heading into the weekend that from an economic perspective, things could really escalate very quickly. Historically, there have been some issues when tensions rise there about the threat of the Strait of Hormuz being closed, and a lot of oil runs through that part of the world. Now, despite these threats, oil flows through the strait, which again has 1/3 of the world's seaborne oil, remain unaffected. Brent crude briefly surged to 5.5%, but closed down 2.5%, indicating traders don't really expect any escalation that would impact global supply routes. Now, Israel did hit Iranian fuel depots and gas plants, while Iran retaliated against Israeli refinery infrastructure, but they both did a pretty good job of avoiding oil export terminals. Why does that matter? Well, if Iran gets their oil export terminals hit aggressively, they are not incentivized to keep the strait open. If they can't benefit from the export of oil through the strait, what stops them from attempting to close it? Now, ship tracking data is showing that tankers are still moving, right? Fewer are docking at Iran's ports, but this appears more to be precautionary rather than some sort of blockade within that part of the world that's preventing them from getting there. Now, that area that they are avoiding is actually handling 90% of Iran's oil exports. So you could see that if tanker activity continues to slow, well, maybe Iran is then incentivized to apply economic pressure. Iran produces about 3.2 million barrels per day and exports over half, mainly to China, raising the stakes for Tehran to keep the strait open. If China, who is certainly the most influential of countries that are in Iran's corner, for better or for worse, well, Iran is less likely to hurt its big economic ally. Also, their improved ties with Saudi Arabia between the US and Israel could reduce the likelihood that Iran will block the strait or escalate further. For now, risks still do remain low, but it is an area of the world where tensions tend to rise and rise quickly. So understanding the effects that it has, not just on oil profits, not just on oil companies, but how important oil is as an input cost across the board, can show you some of the risks out there to the market overall. All right, let's pivot back to the InvestTalk voice bank.
I was trying to contact you guys about ASIX, ASIX, which is AdvanSix Incorporated. It's a common stock. I own it. I'm trying to see what's your outlook on this. If you could take a look at the financials and let me know where you see this stock going in the future. I try to hold this stuff as long as I can. So I'm a long-term investor. Appreciate the show. Thanks for all that you do. Have a great day.
AdvanSix Inc., ASIX, is a fertilizer, agrochemical, plastic, building, and construction company, right? And so 30% of their business comes from those plant nutrients. About 29% of their business comes from those chemical intermediaries, and about 23% from nylon. Pretty well diversified across the agrochemical space. Now, year to date, it's down about 14.81%, up about 5.94% over the past 52 weeks. Very small name, about $630 million market cap, actually $660 as of the close today. It's up 1.17%. And overall, right, from a relative valuation perspective, well, it's trading about 0.8 times price to book, 3.6 times its cash flow. So it does look pretty cheap right now. Let me pull something up on my other screen here while we look over here. Let's look at growth, about 3.2% on an annualized basis. Well, most of that growth was from 2019 to 2022. Then it dropped off from 1.9 billion in revenue to 1.5, dropping off again this year. And at the same time, margins collapsing a little bit from 8.8% as a high net margin to about 2.9%. And so because of the business it's in, agrochemicals, right, chemical intermediaries, ammonium sulfate, because of the ways that those markets have moved, in spite of having a strong Q1 in terms of beating estimates, cyclical exposure to those commodity prices, oil and feedstocks, have really driven the price of this thing down year to date. Now, with the positive earnings, well, they're up about 91 basis points over the past 3 months. But I think this is, again, one of those names that faces some pretty important headwinds. And at the same time, right, on a $643 million or $660 million market cap company, they got about $361 million in debt. I'm afraid that maybe you can catch this on the downside of the cycle, competition and pricing pressure, definitely still high in the basic materials, this segment of the materials market. And when you're a small company like this, you don't really have a lot of pricing power. You don't really have a lot of abilities to absorb those costs. And so if you want to have small exposure to this, maybe you're trying to catch the bottom here of the chemical market, that's fine, right? The debt levels aren't crazy high. Cash flow isn't terrible. Growth isn't horrendous relative to their industry. 2024, they actually outperformed their industry, but they're doing pretty poorly this year. So I'm going to take that back. I think if you want to go within this space, I would look elsewhere. Larger, more established company can deal with those cyclical headwinds. That's AdvanSix Inc., ticker ASIX.
My name is Andy from Florida. I would like to get your take on CHWY, CHWY. I do own them at a little higher prices than where it is now. I would like your take on to hold it or just take the loss and move on. Really appreciate your show. Thank you so much.
CHWY is a online retailer of pet food and pet products. I really like CHWY. Got some toys for my cats there. They also have this great service where you can just chat with a vet when you have crazy parent issues. That's besides the point. Either way, CHWY's revenue looked pretty solid year over year, up 8.3%, beat expectations. Adjusted EPS at 35 cents per share relative to the 34 consensus. But despite these things, shares dropped, right? They had been on a upward march since, well, about a year ago, because they're up 88.17% over the past 52 weeks, up 24.40% year to date, but down from their local highs, we'll call it, of around 47 a share, rebounding back to about 41.66. Now, their full year guidance, they reaffirmed at pretty solid growth. And their margins that have been kind of all over the place are starting to stabilize a little bit. They started making money in 2023 relative to the last 6 years, and their margins have been growing, though falling again from that projection from 3.3% to 1.7% this year. And revenue set to grow again at a decent clip. Again, for an online retailer, not bad. You can't really get the same growth you were getting in the beginning over here. A lot of people are spending money on online retailers and a lot of people are getting pets. But either way, there's a lot of positivity in the market here. So the question is now a good time to buy into it or hold on to it, or should you trim it now that you're at some of these highs? Well, frankly, I think it's really expensive. Even in spite of this drop off in the past couple of days, it's trading at 69.7 times forward-looking earnings. Price to book about 46 times. Price to cash flow about 29.5 times. Incredibly expensive. And so as a company that's facing a lot of these margin pressures that you're seeing, cut in half year over year nearly, I don't know. I would maybe at least sell some of my position, given that you've had a pretty decent run up to a place that this stock really hasn't been at since 2023. That's at CHWY Inc., ticker CHWY. Thanks for the call. All right, last thing I want to talk about briefly is how bleak it is out there for the young kids. College grads aged 20 to 24 face a 6.6% unemployment rate, well above the 4% national average and near decade highs outside of the pandemic. You're also seeing a widening generation gap. People aged 35 to 44 with degrees, unemployment 2.2%. New York Fed found a steep drop in job prospects for grads aged 20 to 27, with unemployment averaging 5.8% in Q1. And overall, hiring has declined by 1.5 million in the first 4 months of 2025. According to LinkedIn, entry-level hirings are down 17% from pre-pandemic levels. Now, some of that is maybe a post-pandemic shift, right? From a lot of people that are getting degrees in computer science and trying to get software engineering jobs, where a lot of those companies have cut back, as opposed to healthcare and construction, where you've seen a decent amount of growth. A lot of it could be AI pressures. Roles that once served as training grounds for young workers, for several young workers, can be done with a lot of automation and one person. Teens are hit the hardest. High school grads age 18 to 19 face a 14.5% unemployment rate, more than triple the national average. Many job seekers are reporting ghosting by employers. Some are taking time off to rethink plans amid a weak job landscape. Why do I mention this? Probably not a lot of 18-year-olds listening, though if they do, you're ahead of the curve. But it's important to see what is happening in society, right? In the younger part of the population, because those effects carry on. As generations get older, their economic power is supposed to increase, their consumption increases, their contribution increases. What we're seeing right now is a pretty bleak situation for those seeking first jobs. I'm Luke Guerrero. This completes another InvestTalk program. Justin and I thank you for listening, and once again encourage you, tell at least one person about InvestTalk. They can get it at iTunes, Google Play, and Spotify. And more than anything, if today's show made you think about your financial picture, your investments, your taxes, your retirement, whether it's really working, just head over to investtalk.com and click Portfolio Review. It is a free health checkup. It is a financial health checkup. We love talking to all of our listeners, our clients, anybody who's interested, free and confidential. Independent thinking, shared success. This is InvestTalk. Good night.